We just were above the prior closing high on the Dow, the record high. We were about plus 165, and we're right about that area right now. Of course, Bob Pisani's watching all of it and what's moving on the floor. Hey, Bob.
The important thing here is a great start to the new year, Scotty. 5-1 advancing the declining stocks, new highs across the board in several big global sectors. The key story today is actually not in the U.S. China cut its bank reserve ratios again. This, in theory, frees up more money for lending by the banks over there. Essentially, it means more liquidity, folks. That's the important thing. This is igniting a nice rally over in Europe, the Euro Stoxx 600. This is a new high for that index. And remember, Europe has lagged the United States for years now. Last year, up about 20% overall for some of the key European indexes. So finally, a decent year for them. Hang Seng also not keeping up to the United States last year, finally doing a little bit better. Shanghai also 7-month high there. Let's take a look at here in the United States. Chinese stocks here, MCHI, the broader China ETF. Sitting up nicely here. Alibaba, new high here at the New York Stock Exchange. That's important. Semis, of course. This is all China-related. Emerging markets, the EEM index, metals and mining strong. Utilities are lagging here. So, again, you see the effects of more liquidity in China, even here on the U.S. stock market. The question is, what's 2020 going to look like? Exact opposite situation. I keep emphasizing this, how different it was. On January 1st, 2019, we had earnings recession fears, and the stocks were cheap. 14 times, 13.9 forward earnings. That's below the historic average. 15 or 16 is typical. Here today, January 1st, 2020, we don't have any recession or earnings recession fears immediately on the horizon, and stocks are expensive. Exactly the opposite. 18 times forward earnings. That's pricey here. So the question is, can we get some better earnings in 2020 so we don't have to have such a high multiple at 18? That's a little bit risky. So here's 2018. We had this huge push up in earnings growth largely because of the tax cuts, also an improving economy. 2019, we're not done yet, but essentially, let's call it flat. I've been saying flattish for 6 months. I think that's a fair way to characterize it. And early estimates for 2020, almost 10%. We all know that these analyst estimates tend to be high. The real numbers here probably 3-4 percentage points lower. So a lot of the strategists have 5% earnings growth for 2020 or so. That's a fair number. At least that would take some pressure off of that earnings multiple. Let's take a look at the early reporters here. We've got a number of companies, 15 or so, that do November ending quarters, including some very big companies. And you want to see how the analysts kind of reduce their numbers or increase them for the first quarter. So we had estimates lower for some of the big reporters. FedEx in particular. Nike had the numbers lower by analysts in the first quarter. Micron, General Mills, and Carnival. That's a pretty big group. That's about 2/3 of the reporters. 10 out of the 15 had the numbers lowered by analysts in the first quarter after the reports came out at the end of November. Some, like AutoZone and Costco, they had it raised here, but those companies have been doing terrifically overall. What's the story? It's a very mixed picture here. You still want to watch. The number's not clear that we're going to have a big earnings pickup by the early reporters so far. Remember something here for the Santa Claus rally here. We always like to watch this. Last 5 days of the 2019, first two 2020, average gain 1.3%. So far at the open here, we're up 0.7%. A little bit below typical numbers here, Mike, but given the run-up that we had in the month of December, maybe that's to be expected.